Hello investors. It's been another good month for the market. The index is up about 3.6%. Your portfolio is again done much better. We are north of 4%, well above 4% in fact. And I think that's pretty heartening. Of course, months of underperformance and outperformance will continue. But really what is satisfying for me this month is that the quarterly numbers that came out for your portfolio stocks, I think were very good. And this month I'm going to share with you your top 10 holdings and how they have performed basis the quarterly numbers that have come out. You know, as I said that for me, every quarterly numbers is like a report card. You know, when we were in school and the report used to come, there was always a certain amount of caution, fear, panic. And for me, when this works out very well, it is a big relief. At the moment, we think that your portfolio stocks have actually come out with splendid performance. So in my first slide, what you will see is the top 10 holdings. I'll just read them out to you. Varun Beverages, Naveen Fluorine, Tube Investments, Apar, ICICI Bank, LG Equipment, SRF, SBI, Sonata Software and Hindustan Aeronauticals. So first and foremost, you'll see that they're a very diversified family. And what we really think is that the composition as they are among the large, mid and small caps, you find that there is a bit of bias towards the mid and small cap. Why we think that this is a very good strategy for the coming few months? We feel that the market per se is actually in a very good uptrend. We have been sharing our optimistic view on the market, but when the market goes north, it is always the small and mid caps outperform. And that is why you will find that the weightage or the allocation towards the mid and small is much higher than maybe most of the flexi cap funds. If you see the flexi cap funds, they may have about 60% in large cap. But you will find that we feel very bullish on the market and we feel that we can create alpha in your portfolio by actually being overweight in these spaces. So this is really the part of the strategy. Another reason why I feel that we should be overweight in this space is because I do think that we are seeing a revival in the industrial cycle, and that is what the quarterly numbers are telling us. And we see that whenever such things pan out, the small and mid cap space far outperform the large cap space. Even if you look at the large cap stocks, they are generally the large banks that really form this quadrant, and that is why we can see a very good skew in our portfolio, because this is where we feel, or this strategy we feel going ahead will create alpha in your portfolio. So this is really the portfolio mix in terms of market cap. Now we get down to earnings. You know, as trend followers, we have been saying that we look at trending earnings and trending price. So what we are really going to look at today is trending earnings, because we are talking about our quarterly numbers. Now, trending earnings is nothing but companies that continue to deliver good profitability and good growth in the quarters to come. And very often I realize that this is what is quality. You know, we use the term quality stocks very loosely, but quality stocks is not just a very famous name or some fancy sector or some fancy management. Quality is nothing but a company's ability to deliver profits consistently. You know, I have seen in my career a lot of so-called marquee names really get smashed because they were not able to deliver the numbers. And very often you will find companies which are not very known, but the moment they start giving consistently good numbers, they become quality. So as trend followers, we are looking for trending earnings, and trending earnings is nothing but the hallmark of quality. So what you will see is that in your portfolio, we really have a very high quality. It's, as I said, it's not names, but it is profitability that determines quality in the long run. So what you will see is that the 10 portfolio stocks, top 10 holdings we have discussed already. If you look at the sales growth, you know, the 3-year CAGR, we think 3 years is a very good number because it definitely is 12 quarters. That's a lot of time to prove yourself. Also, it's a good, representation of a cycle. So there you will see listed that most of your portfolio stocks have showing very good growth. In fact, the average growth of your top 20 stocks or top 10 stocks is about 22% plus, whereas the Nifty 50, which is again the top 50 stocks, is representing around a 15% or thereabouts growth. So you will see that your portfolio for the last 3 years has been delivering superior sales growth. That means the growth of your portfolio is much superior to even the Nifty 50 stock by a fair amount. In the green column, you will see the PAT growth. PAT is nothing but profitability. Sales is good, but it must translate to profitability. So here you will see that your portfolio, the top 10 holdings, are actually delivering almost 45% PAT growth for 3 years, CAGR, versus the Nifty, which is around 20-21%. So the profitability of your portfolio is twice as much as the top 50 stocks, which is in the Nifty 50. So this really is what quality is. As I repeat, quality is not a famous name, quality is earnings. And as trend followers, it is our strength that we are so objective that we don't fall prey to all the storytelling. We are very focused on earnings, and we feel that ultimately it is earnings that is going to drive prices. And actually, this is the best risk control mechanism. Because markets wobble, a lot of events happen, elections and geopolitical etc. However, you will always notice that companies that are able to sustain profitability are the ones that recover. So this is the kind of portfolio we want to build for you, where you can sleep at night, because they are not just a fancy name, but they are names which are backed by superior profitability. And you can see that the profitability over the last 3 years is much superior to where the Nifty 50 is. The next slide I want to share with you is something that we look at as return on equity, because it's one thing to have sales and profitability, but what does it mean for you as shareholders? What is your return on equity? So if you see this column, you will see that most of these companies are giving a very healthy return on equity, which is almost at around 22%. This is again as I repeat, much better than the top Nifty 50 stocks. And return on equity is a very important measure, because remember, we are talking about 3 years, so that's 12 quarters. This nothing but proves a management's ability to execute efficiently manage and deploy the capital which is yours over such a long period of time. And this is what really helps in better return ratios. And this is very visible in the columns that Air is. So we favor companies that have a very good track record, or which have a trend in earnings, which have a trend in profitability, and more importantly have very good return ratios. And the good thing is that we very often see that if you look at the big wealth creators in the past, they have consistently exhibited these qualities. This is where the multi-baggers are. However, it is these companies which tend to be sometimes expensive on P's, because these are the stocks which the market favors. And this is really what creates or constitutes our portfolio, which is trending earnings, and these trending earnings ultimately lead to trending prices. Of course, this was the past, the last 3 years, and we mentioned at the start we are talking about earnings this quarter. So how have the earnings been this quarter? So if you look at the top 10 stocks, you will clearly see that this is the Jan to March quarter compared to the Jan to March quarter of the previous year. So we will see that of the top 10 stocks, that there has been almost a sales growth of around 28%. And this again is much ahead of where the Nifty is, which is almost at around 15%. So your companies are growing at almost twice the pace of the top Nifty 50 companies. If you look at profitability, which is in the green column, the profitability is really superb. The average profitability, though averages may not be the perfect way, but for purpose of simplicity, that's how we'd like to look at it, is up about 69%. Versus the Nifty, which is at around 30-35%. So your company's profitability on the quarter-to-quarter basis is actually twice as much as the top Nifty 50 stocks. So this really represents the superiority of earnings. And why we like to place a lot of importance on quarterly earnings, because this gives you the immediate trend. We had talked about 3 years before that, but that is history. Yes, we like to have historically good earnings in our pocket, but the fact is that how are the companies doing in the short run? And this is how we monitor the portfolio. You will see that a lot of companies are delivering good results, but there are some which may not be, which is very visible in the columns that there are. And these become actually red signals for us. These become red flags, because when companies do not have market beating returns, we know that, okay, we need to watch this closely. Does that mean we sell it immediately? The answer is no. But the fact is that this comes under our watch list. And what we combine at this stage is how the market is reacting. Because sometimes earnings do flatten out and we have to see how the market reacts. We have to see how the confidence plays out. And this is where the whole theory of trending prices comes in, which we've shared in earlier technical charts. So this combination really helps us to flag out what we should sell. Because at the end of the day, what I would like to have in your portfolio is stocks that all have phenomenal earnings and phenomenal price trends. And that we feel is what really ultimately creates long-term wealth. You can see that very well reflected in your portfolio. As I said, that these quarterly numbers have been very, very satisfying us. You can see those numbers on your screen. And with that optimism and fingers crossed, I'll leave you for this month. Thank you.